eBay has been a king of share buybacks. Since 2014, they have more than half their share count, and with stock trading at a P of 10, maybe it's a time to look at it. First of all, we can see eBay as a business has not really grown that much. They had some growth from 2016 to 2018, but ever since then, they have stayed kind of flat. Of course, they sold off some businesses here and there, they also bought some here and there, but overall the organic eBay business has not really grown much. And we can also see this from their gross merchandise volume. Organic revenue growth hasn't been there in some time. Yes, they have done some acquisitions, but organically the business is not growing. They have one growing business, which is advertising, so people advertising on eBay. This is also a business which is very good for Amazon. Here they are achieving good growth rates, 20% year over year. However, it is still a very small business. You gotta remember, there will be a ceiling on this. If gross merchandise volume doesn't grow, which means how much stuff is being sold on eBay, advertising will eventually flatline. So those 20% growth rates, they won't stay forever. However, there's still some room for eBay to grow here. Free cash flow last quarter has been a one-off. You should ignore this. This is just due to accounting. What do they use this capital for? Share buybacks and dividends. They have a very big investment in Advertina. It's not like they bought this investment. When they sold off a huge chunk of their business, they got a share in Advertina. Now, however, where does this leave eBay? It is not going to have big growth moments. There's also a reason for that. eBay is not really investing a lot. Capital expenditures have declined. Of course, they sold some parts of the business, so capital expenditures should go down over time, but it has still massively declined. Operating cash flow has stayed kind of flat ever since 2017, and so has free cash flow. If you ignore this one-off quarter, it has always been at around 2.5 billion for the last 10 years. There's not been really a lot of movement there. And basically they use all of his free cash flow to buy back shares and to pay out a dividend. Here, when they got a lot of cash from a divestiture, they immediately bought back more shares than they could afford. But on average, usually around $2.5 billion in shares bought back. And also the small dividend, which is not really a lot, around 500 million right now. But if we look overall, 4.3 billion in buybacks, 2.4 billion in free cash flow, $2.6 billion in buybacks, 1.9 billion in free cash flow, 1.3 million buybacks, 500 million dividends. They basically put all their free cash flow into share buybacks. And that is why the share has risen. The operating business has not performed well. Of course, some sell-offs, as we already mentioned, but eBay is not a growing business. However, they're able to increase free cash flow per share by just buying back shares. And they're going to even increase that. They expect buybacks and dividends combined to reach approximately 130% of free cash flow. So they're taking on leverage to boost stock prices. And that is what I don't like in non-growing businesses. Some businesses can do that. If they're fast growing, taking on some debt to buy back cheap shares at the time might be good. But eBay is not a growing business. So if they take on debt now, future cash flow that can be paid out to shareholders will be lower. So this is just some financial engineering to boost the stock in the short term. So let's assume they're gonna average $2.5 billion in free cash flow per year, which has been the average for the last 8 years. That would still be at around 11 multiple. Tobacco stocks trade at a lower market cap, and they remind me a lot of eBay. Another stock, British American Tobacco, a company which has not grown revenue since some time, but still has some business segments that at least grow, is trading at a lower multiple. So we're gonna get into the numbers in a second, but on the first look, eBay does not seem very good to me. Sure, they pay out a nice dividend, sure they buy back some shares, but an 11 multiple does not seem good for a company like this. Let's go off with $4.7 in free cash flow per share. If they continue to buy back shares, in the past they have bought back around 6% of shares yearly. Let's just keep this going. I would think this is fairly reasonable. They're going to be able to continue to do this. And let's say the stock is going to trade at a slightly higher multiple in the future. Slightly higher than the around 11 it's trading at right now. They're going to pay out 25% of their free cash flow in dividends, the rest is going to be used to buy back shares. Slight discount due to taxes. Well, under these assumptions, we would come to $45. Current value is 52. Now, what if it goes a bit better? Let's say the core business is going to grow at around 1% per year, and it's going to get a way higher multiple, 15. Then we would come to $59 a share, and here it would be a slight buy. We would get a bit more than our required return of 10%. Especially this multiple, I find a bit questionable. I do not think eBay is going to reach a 15 multiple. Now, what if it goes worse? Maybe their free cash flow declines by a bit, their core business deteriorates over time. They're only going to be able to buy back 4% of the shares yearly. And they only get a 10 multiple. Slightly lower, only by a bit than today. Well then, $33 a share. Now, what do I take from this? I do not like eBay that much as a stock. I sometimes use its products, very rarely, only in some situations. It has the ad segment, which is nice, but the core business is not growing. The gross merchandise volume is not growing, so the company is also not going to grow in the long term. They have the share buybacks, they're going to be able to leverage the company a bit, but in the long term that's gonna hurt the company. In the short term it may boost stock prices, but not in the long term. With eBay, I just see a company which is not growing, just like a tobacco stock, but not trading at the multiples of a tobacco stock. The tobacco stocks trade at around an 8 multiple right now. eBay trades at 11. And if eBay would be trading at an 8 multiple right now, I would probably say, yeah, that would be a good buy. It has decent cash flows over time, has shown them to be very consistent, buys back a lot of shares each year, nice dividend, but not at a multiple of 11. If it would trade at around 8, which is tobacco stock territory, then yes, it would be a good buy. I do not like it. Maybe the business is gonna start growing again in the future. However, I just doubt it. They're not investing in the company. Whenever they get more cash in, because for example they sold a large part of a business, they put it into share buybacks. It's not a bad thing to do, but at this level, it just seems like they're trying to please Wall Street, shortly leverage the business over time to increase the stock price with share buybacks. In this case, I prefer to own a tobacco company. What do you think about the eBay? Write it down below. Have a good day.